Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Louis, and I'm excited to share today's discussion with you. As we navigate the complex landscape of investments and market trends, it's essential to stay informed and up to date on the latest developments. Today, we're taking a closer look at the Indian stock market, where experts are weighing in on the performance of various sectors and companies. Sandip Sabharwal, a seasoned market analyst, recently shared his insights on the current state of the market, highlighting areas of growth and potential risks. According to Sabharwal, the IT sector, particularly companies like Infosys and Tech Mahindra, may face challenges due to global economic uncertainty and trade tensions. However, he also sees opportunities in domestic-focused autos, such as M&M and Maruti, which could benefit from monetary and fiscal stimulus. In the banking sector, Sabharwal notes that Axis Bank has become more conservative under its current management, taking write-offs early and provisioning for potential bad loans. This approach could lead to improved performance and a better valuation outlook for the bank. When it comes to FMCG stocks, Sabharwal favors companies like Godrej Consumer, Dabur, and Jyothy Labs, which offer a balance of growth and reasonable valuations. He also mentions that Britannia's growth and margin outlook will be crucial in determining its performance. In the automotive space, Sabharwal believes that Tata Motors faces significant uncertainties due to its global portfolio and trade tension. However, he suggests that if tariffs are removed, the stock could see a decent bounce back. As we consider these insights, it's essential to remember that market predictions are subject to change and may be influenced by various factors. As investors, it's crucial to stay informed, assess risks, and make decisions based on our individual financial goals and risk tolerance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show, and now it's time to dive into the world of finance and economics. Today, we're going to explore the recent developments in the Indian bond market and their potential implications on the global economy. According to a recent interview with Lakshmi Iyer, an expert in the field, the Indian bond market has been experiencing significant growth, driven by the inclusion of Indian bonds in various global benchmark indices such as JP Morgan and Bloomberg. This move is expected to attract more foreign investors to the Indian market, which could lead to increased liquidity and lower borrowing costs for the Indian government. However, Iyer also cautions that the current uncertainty in the global economy, coupled with the risk of a slowdown in growth, may impact the bond-related flows going forward. She notes that while the inclusions in the global benchmark indices are a positive development, they may not be enough to offset the potential risks associated with investing in emerging markets. In terms of the Indian rupee, Iyer expects it to remain relatively stable, with a possible range of 84.5 to 85.5 against the US dollar. She attributes this stability to the Reserve Bank of India's efforts to manage currency fluctuations and maintain liquidity in the banking system. It's worth noting that these developments are not unique to India, as many emerging markets are experiencing similar trends. The key takeaway is that investors need to be aware of the potential risks and opportunities associated with investing in these markets and adjust their strategies accordingly. As we navigate this complex landscape, it's essential to remain informed and up to date on the latest market developments. We'll continue to monitor these trends and provide you with expert analysis and insights to help you make more informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's episode with a fascinating story that highlights the complex interplay between politics, education, and finance. You might have heard that Harvard University is exploring the sale of approximately $1 billion worth of private equity stakes. Now let's dive into the details. According to reports from reputable sources such as Reuters and the Economic Times, Harvard's endowment management company is in advanced talks to sell these private equity fund interests. It's essential to note that this decision appears to be unrelated to the recent threats from President Trump to withhold federal funding from colleges and universities over various issues, including pro-Palestinian campus protests. The sale is reportedly being facilitated by Jefferies Financial Group, with Lexington Partners emerging as a potential buyer. This move doesn't seem to indicate a significant shift in Harvard's asset allocation strategy, given that the university had already invested 39% of its $53 billion endowment in private equity assets as of 2024. What's interesting is that this development comes on the heels of Harvard's announcement to borrow $750 million from Wall Street as part of contingency measures. It's also worth mentioning that Yale University is exploring a similar sale of private equity fund interests, advised by investment banking firm Evercore. Now, let's take a step back and analyze the situation. On one hand, it's understandable that universities like Harvard are seeking to navigate the current market volatility and potential funding uncertainties. On the other hand, some might argue that these institutions should resist pressure from political forces and maintain their commitment to diversity, equity, and inclusion programs. As always, we strive to provide a balanced perspective on the Riskwiser Zone. It's crucial for investors, educators, and policymakers to engage in open and respectful dialogue about these complex issues. By doing so, we can work towards creating a more informed and resilient financial ecosystem. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.